Welcome back, viewers. Today we will delve into the fundamentals of candlestick wicks, also known as shadows. In previous segments, we explored the formation of candlesticks and the 4 key price points they represent. I trust you are now familiar with these price points. In this lesson, our focus will be on understanding wicks. A candlestick displaying a long upper wick along with a lower wick indicates that buyers in the market have bid price higher. This suggests that at a certain point during the candlestick formation, the price reached its highest level due to increased demand from buyers. However, subsequently, sellers exerted their influence, leading to a decline in price. When we refer to sellers driving price down, it means there was an ample supply of assets overpowering the demand at that time. This caused the price to retract from its peak, closing at a level near its opening price. Allow me to illustrate this concept with a practical example using a specific candle. Observe this candle, which features a prominent upper wick. This upper wick exemplifies the seller's action in the market. The candle commenced with an opening price at this level and ascended to its peak. Yet, a significant sell-off occurred initiated by sellers, compelling the price to retreat back to its closing level, situated close to the opening price. The extended upper wick effectively reflects the dominance of sellers in the market, indicating more sellers than buyers during that period. Conversely, a candlestick exhibiting a lengthy lower wick paired with a short upper wick signifies that sellers in the market bid price lower. At a particular point in time, the price dropped to its lowest level due to increased selling pressure. Subsequently, buyers stepped into the market, outweighing the number of sellers, which led to a price increase. When buyers outnumber sellers, there is a higher demand for the asset, resulting in a rise in price. For instance, in an actual price chart, it might appear as follows. Initially, the price hovered close to the lowest point, forming a red candle. By the end of the day, buyers entered the market, bolstering the price upward. This influx of buyers, indicating a substantial demand, pushed the price to its closing level, which was notably close to the opening price. The activities of the buyers are aptly represented by this scenario, leading to a rise in the chart. In summary, a long upper wick signifies a prevalence of sellers in the market, whereas a long or lower wick indicates an abundance of buyers. The interplay between buyers and sellers influences the price movement on the chart, ultimately shaping the market's trends. I hope this clarifies the significance of upper and lower wicks. With this understanding, you can better interpret price movement in your future analysis. Thank you for joining this discussion on wick basics. Stay tuned for our next informative video.